So you have heard me saying invest with conviction 1,000 times. I have a high level of confidence in your strategy, in the stocks you buy. But what if your confidence is wrong? What if your strategy is wrong? What if your beliefs as an investor are wrong and jeopardize your retirement goals? Today, we're going to look at investment biases. So those biases are beliefs, the things that you believe that will work, should work, and you trade accordingly. But then, if you don't know what you're doing wrong, this is probably why you're losing money. So today we're going to look at 4 investment biases, and I'm also going to provide you with the solution to avoid falling into those investment traps. So the first one is the confirmation bias. Confirmation bias is quite easy, is you are going for people, articles, videos that are telling you that you're right in what you believe in. And here's a good example. Not too long ago, I did 2 videos back to back about covered calls. So the first one was covered calls ETF suck, and the other one was can you retire on GEPI? And ironically, those 2 videos got me a lot of hate, a lot of bad comments, and mostly because people didn't want to hear from that. They rather, if they love covered calls, they don't want to see the math, and they rather focus on all the other points. So some investor brought some interesting points in the comments. We had like interesting discussion, and that was fine. But some others were just like, Mike, you're just a pile of whatever you may think that you could had at the end of this sentence. And they just said, oh, I'm unfollowing you, I'm blocking you, I don't want to hear you about it. So there you go. You're trying to build a confirmation, and anybody else that is telling you something that is going against that belief, you just cut it out. So that's kind of like seen as clearing down the noise, but at the same time, you're not trying to look at the other side. And as an investor, it's super important. I know that the confirmation bias is very strong among the dividend investors crowd. I'm part of it, but I also like to see what others have to say. And when I see someone that prefers to invest in factors investing or ETF investing, I'm willing to listen what they have to say. It's going to encourage me to have a better point of view, sometimes maybe just to smoother down some of my beliefs as well, and have a broader horizon when it comes down to investing. The next investment bias is the consensus. Consensus are pretty simple. I would call it's the noise that everybody makes, mostly the media and everybody that goes into a trend. So everybody's telling you right now that AI is the new thing, that you should have AI in your portfolio, and if you do not have it, you are missing something. Well, you may have recalled that we had a similar bubble around the cannabis industry, and as you can see with Canopy Growth, weed.to, it didn't turn out very well. But the thing is, back in 2017 and 2019 and 2018, I remember I was doing webinars, and every single time during the live Q&A, I had investors asking me about the cannabis industry. And they were like, oh, how many stocks do you think we should have? Should we go for an ETF that tracks most of them? Should I go for a leader? Is it going to be a good thing in my portfolio? I don't want to miss out on this investment opportunity because everybody is saying that it's going to be the next big thing. And when everybody says that, well, you have to take a step back and just say, does it fit my investment strategy? Because sometimes it just doesn't fit my investment strategies, and that's fine. So since I focus on dividend growth investing, whenever I hear about those like small startups doing like crazy stuff with AI, I'm like, well, good for them and good for investors that are willing to take that risk. And maybe they're going to be rewarded, but that's not part of my strategy. So I don't need to look for the consensus. I just need to get back to my strategy. So to avoid confirmation bias and consensus bias, I would say it's important to understand what's going on, to hear a little bit more about the other side of the story, but then you have to bring everything back to your strategy. And if you do not have a clear one, that's probably the time to start working on it. And in order to help you out, you can actually download my DSR recession-proof workbook. It's like more than 70 pages explaining you step by step how to determine your asset allocation, your sector allocation, how to get a clear buy and sell process, including valuation, including all the other questions you may have. It is really a workbook where you have questions, you will have to work on it, and once you're done, you will have a clear investment strategy that will help you to cut down the noise, but still consider the context around others people's opinion. So you can download it at dividendstocksrock.com/workbook. The link is just right there or in the description below. So dividendstocksrock.com/workbook. You just put in your email and you're going to receive it for free. So the next two investment biases are quite similar, and those are insight bias and anchoring bias. So what they have in common is, you look back and then you get stuck with something that happened in the past. The first exercise I would like to do is with the insight. So let's take a look at the S&P 500 SPY during a unknown period of time, right? So a lot of investors would tell you, that was obvious that the S&P 500 would skyrocket during that period, and this is why I invested. Or they did not invest, but it was clearly obvious. And then as you can see at the end of this graph, and I took the dates off on purpose because I want you to think about it, what you see is a big drop, like a 10% drop, like suddenly during the last few days of this graph. And then my question to you is it obvious that the S&P 500 will fall or not? Or I don't know, just think a little bit about it to see if it's that obvious now that you don't know what are the dates, right? Now you see the date and you see that I have cherry picked the beginning of the bull market right after the financial crisis. So the graph starts in March of 2009 and it ends on September 2015, right at the beginning of what we were just starting to be a bit cautious about concern. The stock market was trading at a all-time high. Everybody was saying, I see the writing on the walls, and then it's going to be like a big catastrophe. We're going to have another market crash because it's coming. It's been like more than 5 years that we're running onto this bull market. Well, guess what happened? So what happened is obvious, right? So the stock market kept on going up most of the time and then added another 233% total return from September 2015 all the way up to July 30th of 2024. I don't know about you, but when I look at those graphs, I don't see anything obvious. But people are just telling me, well, Mike, that was obvious. Or if they compare my investment returns or their investment returns, they just quickly go and do, 100% ETF in SPY would have done a lot better. Yeah, but that's insight. You didn't know that. So that's really playing Monday morning quarterback, knowing what you know today, but you didn't know before. So today I'm asking you the same question. Right now, is it obvious that we're going to have a market crash in September and therefore you should sell everything and probably short sell everything so then you can make a lot of profit of what is obvious? Of course, I'm not telling you to do that because that would be very risky and I don't think it's going to work out. So the solution for this investment bias is quite easy. Just stay invested and stick to your strategy. Not too long ago in another webinar when I was talking about unseen mistakes, like hidden mistakes that investors are making, I was saying that if you wait for a pullback, it's going to be very hard to get it and then to invest. And then a northern squirrel, which has been following me for a very long time, which I respect his opinion and always bring great comments. So keep on watching those videos, Northern Squirrel, and keeps on commenting, please. But he said, well, it's easier to take a hit of a market crash when you're up 200%, which he was totally right. It's always easier when I look at my portfolio and I show a lot of profit. I'm like, yeah, if the market crashes, I'm good. If not, I'm just going to continue investing. That's all good. But here's the secret. To reach that 200% return, as we saw with the S&P 500, The only solution is just to stay invested. So if you stick to your strategy, you are going to show those amazing numbers, and you will not have to double guess what was the most important move that you should have made, as you stick to your strategy, you stay invested, and there you go. You will achieve your financial goals. So now let's end up with one of my favorite one, anchoring. So of course, we're talking about price anchoring. So let's start with the perfect example with Algonquin, because I know a lot of you guys have been burned by this stock. I've been burned too, so I like to share my mistakes. And I know that some investors are holding onto those shares, thinking, hoping, wishing that Algonquin will go back to 20 bucks or maybe more. So trying to give a context to Algonquin now, saying, oh, it's trading around like $8, $9, but it will go back to 20 bucks because it was once trading at 20 bucks. You're kind of like telling yourself a fairy tale that is not necessarily going to happen. Maybe it will, maybe it won't, but there's a solution for that. But just before, I want to also highlight price anchoring on the other side. So I see that a lot when people have losers in their portfolio and they're just waiting for a recovery that in most of the time, let's be honest, doesn't happen. But on the other side, when you have a stock on your wait list, on your wish list, and you're just thinking, oh, I'm going to buy this one once it reaches a specific price point. The problem with this strategy is more than often that price point is set based on the past price point. So let's take National Bank as an example over the past 5 years. For a very long time after the stock price surged above 75 bucks, it was trading around like 80, 90, 100 bucks, and there's some fluctuation, but a lot of investors were just like, yeah, now it's trading close to the all-time high or it's at the all-time high. I'm going to wait for a pullback, and I'm going to wait for the stock price to go back to 75 bucks. So what happened? Well, 21 happened, 22 happened, 23 happened. Not kidding, that's 75 bucks. And then fast forward today, the stock price trades above 110, getting maybe closer to 120 at one point. And then investors will reframe this and say, oh, I'm going to wait for the dip again, but this time I'm just going to wait until it drops below 100. Well, between you and me, you picked up the first time the price at 75 with no really good reason. And this time you're telling me that it's going to be a good deal if you can buy it at 90 bucks. Again, without necessarily having a very good explanation. You're just, you want to get a deal. I get that. We all wish we had a deal. And you know what? I'm super happy that I started investing in National Bank in 2003 because that was the moment, the best deal it was since I started investing. You know when I started investing? In 2003. So the best moment would have been way before if I had started investing before. So in the end, the best moment to invest is always today. And tomorrow is always the worst one, unless you're incredibly lucky. So if you're incredibly lucky, you're probably going to make a lot more money if you're gambling instead of investing. But I'm not that lucky. I rather to stick on a clear strategy. So one thing I want to tell you before we end this video, as you can see, trading on beliefs could be wrong. And what is really important here is to have a clear strategy, add context. So hearing the other part, seeing if there's any other counter argument. And when you do that, don't start arguing with other people. Just listen. You know, it's pretty much like when you're arguing with your spouse. If you shut your mouth and you listen, you're going to move a lot forward, a lot faster in your couple than if you keep on arguing. So listen to the other party, put some context. A lot of people are saying, yeah, I'm waiting for Algonquin to go back to 20 bucks. Well, then you have to understand what made that stock trade at $20. And what was it? Well, super low interest rate, aggressive growth by acquisition business model. And Algonquin was also surfing on the greening process. So everything that was renewable back then in 2020, 2021, it was like, oh, we want to invest in those. So those three factors are not there today. Right now, they're struggling with their balance sheet. Interest rates are higher and they're selling assets. So they're doing exactly the opposite of what they used to do. So they're not ready to get back on the growth path yet. Maybe they will. Maybe it's going to take 10 years. Maybe they will never go back in the growth mode they had, because I don't think they're going to make the same mistakes. So who knows what's going to happen? So adding context is super important. But in the end, whether or not you're beating your neighbor, you're beating the market, what is really important with your investment strategy is that you achieve your financial goals. If you do that, you don't need to hear about the noise. You don't need to shift strategies. You don't need to look back in the past and say, oh, I should have done it differently. If you are comfortable with your portfolio, and if you have a high level of conviction in your strategy and it works to reach your financial goals, you don't need more than that. Of course, we all want to generate 20% returns every year, year after year. But really, if you can achieve your goals at 7% and you're doing it right now, there's no other problems. So, all right, guys, let me know about your investment bias that you think you have, or the one that you see from your friends and you cannot find a way to convince them to stop. We're going to see that in the comments. We're going to continue the discussion there. In the meantime, please subscribe to the channel, give me a thumbs up, and don't forget to stay invested.